Welcome to Money Moves. I'm Samantha Lewis, an early stage venture investor at Mercury Fund, where I spend every day thinking about and exploring the intersection of traditional finance and the on-chain world. This show is about what happens when those two disparate systems converge. Throughout our episodes, we're going to explore what this convergence means, what it means for capital markets, for institutions, and for the global financial system. My co-hosts are two people who have spent their entire careers in two very different worlds, one in TradFi and one in crypto. Both of them are now using that expertise to build at the convergence of the two. I'm lucky enough to be the lead investor in both of their companies, and I sit on both of their boards. So my job as a VC and as this podcast host is to shine light on them. I'll be teeing up intellectually stimulating conversations and let these guys roll. The global financial system is getting an upgrade, and that's what this show is about. This week we're talking about all things stablecoins, what they are, why they matter, and who the major players are. So Dave, why don't you kick us off, give us a few minute rundown of what stablecoins are and why they're so important.
Yeah, that's a great question. The simplest way I could say that is stablecoins are digital dollars that exist on public and permissionless financial networks called blockchains. The history of stablecoins and why anyone would want that is actually pretty interesting, and we'll cover that in a lot greater depth throughout this episode. They started as a way for participants in the crypto economy to move fiat dollars over the internet because they didn't have access to bank accounts, right? So stablecoins started as a way for crypto exchanges to allow dollar trading pairs because no crypto exchange could get a bank account. They then moved to really mass proliferation within the crypto economy, especially starting in 2020 with DeFi Summer, where you saw stablecoin market capitalization go from a few single-digit $1 billion to $50 to $100 billion really quick, because people are now using stablecoins as the main medium of exchange in the crypto economy, and especially in DeFi. And the phase that we've entered now with stablecoins is their proliferation and crossing over into mainstream financial services. So essentially what people realize is, hey, these things aren't just good at moving dollars over the internet for crypto trading. They're actually really good at moving dollars over the internet for everything that's involved, for every use case that involves moving dollars over the internet, right? They're faster, cheaper, smarter, more programmable, more accessible. We'll get into all of that. But now today you have major organizations, Stripe, large global banks like JP Morgan and Bank of America, Robinhood, stock exchanges, all who are implementing and using stablecoins as a new payment rail for moving dollars over the internet. I just explained what stablecoins are. Now I'll do a little bit about why they matter. Why do stablecoins matter? Why should anyone care that's listening to this? Well, for one, stablecoins are moving about $10 trillion a month in terms of transaction value. So in terms of just the raw dollar amount of money they're moving, they now frequently surpass MasterCard, Visa, PayPal, Venmo, which is absolutely incredible, right? You know, these card networks took 75 years to get to these transaction volumes. Stablecoins did it in 5 years. Their market capitalization is $300 billion. Most people project that to 10x over the next 5 to 10 years. The two largest issuers of stablecoins, Circle and Tether. Circle is the issuer of USDC. Tether is the issuer of USDT. Are two of the largest holders of U.S. government debt in the world, because every stablecoin is backed primarily by short-dated U.S. Treasury securities, or T-bills, as you would know. And so just in terms of why you should care, we'll go into why they're good, but just why you should care, they are absolutely mammoth today. Tether, as an example, made more money than Goldman Sachs last year. It is one of the most profitable businesses in the entire planet. And is raising.
Yeah, and they have how many employees?
A few hundred. I mean, it's expanded rapidly with, like, I think mostly on the compliance side. But I mean, I think as recent as like 2 years ago, it was like 100 employees, and they're making billions of dollars a year. I can't remember exactly. I think they made $6 billion in the fourth quarter alone last year. I mean, just the size and scope of these companies and the stable coins they issue is astonishing. And I think when I talk to people who are new to this subject, that's one of the things that surprises them the most. Just like, holy hell, how did I not hear about these? Or why am I not hearing more about this? And throughout this entire podcast today, but in future podcasts, we'll talk a lot about all the various sort of avenues we can go down. Why are they different? That's another really important point that, and Ian, I know you're going to want to jump in on one of them. Than say Venmo or PayPal or Cash App, other sort of digital payment mechanisms that we have. Well, for one, they live on public and permissionless blockchains, which is a credibly neutral technology infrastructure that's fundamentally different than sort of the centralized databases that we depend on today. Two, they allow anyone with an internet connection to hold, send, spend, and receive them, which is completely different than the sort of closed loop models that we're familiar with, Cash App or Venmo. You need to onboard to Venmo, you need to onboard to Cash App, you need to onboard to Zelle, right, to use those things. And then you can only transfer them to other Venmo, Cash App, or Zelle users. Stablecoins are completely open and permissionless. Anyone with an internet connection can hold a stablecoin, can buy a stablecoin, can send a stablecoin. That's a completely different paradigm. The third biggest difference, and I'll pass it over to Ian to talk about why this is so transformative, is they are digital bearer instruments. So what do I mean by digital bearer instruments? That means that physical ownership over a stablecoin, which is evidenced by ownership of the private key that allows you to move that stablecoin, to authorize the blockchain to move that stablecoin, is the same as owning a $20 bill or a bar of gold. Your possession of that is how the world knows that you own that. You're not depending on any sort of intermediaries or third parties or middlemen to say, hey, you evidenced the ownership of that. What that means is you can actually lose a stablecoin. You can lose it forever. If I could print off $1 billion of stablecoins onto a USB stick. If I lose that USB stick, my $1 billion is gone. And so that's a feature and a bug, but they've essentially transformed digital dollars into a bearer instrument. So they're cash-like instruments, which is also very different than the likes of most of the digital payment systems we use today.
Like many aspects of crypto, there's an aspect here which is a child of '08. Namely, in a bearer instrument-based transaction, the credit risk is reduced substantially, really to zero. And because these bearer instruments present zero counterparty risk, they can effectuate instantaneous execution with 100% certainty. And if you think about all of the times that we see in the financial markets, the haggling that goes on over the price of an instrument, only to see the buyer not have the money to pay, or the money come through late, or there be some sort of interbank liability that comes along with that, that doesn't exist here. And so that opens up an efficiency in markets that is at the speed of the internet. And there are still many multi-trillion-dollar markets which do not operate at the speed of the internet, many who are more heterogeneous than they need to be because there is so much execution and transaction friction. And so as we go through the adoption curve of stables, from, as Dave was saying, the means of exchange to buy crypto when the crypto firms themselves couldn't get bank accounts, to what I think is probably the next big cohort, which was folks that were trying to save in dollars that didn't have access to fiat dollars or bank liability dollars, and saw stables as a way to save in dollars. And there's phenomenal examples of that in whether it's Argentina or Venezuela or Turkey or parts of Africa, et cetera. That's hugely important. And then we saw a huge adoption from the efficiency here of corporates stepping in and moving stablecoins to one another around the world at the speed of the internet without needing to use the banking system, without needing to pay those fees. Another really important milestone. And now we're going to see adoption here as stablecoins become the core of execution in markets where the lack of assurance around execution has resulted in a lack of liquidity and a lower velocity of capital than you would expect in 2026.
And let's talk, just in terms of how different that is from today's banking system. And we saw this as recently as March 2023. A lot of people forget that current money, commercial banking deposits, are just liabilities, right? They are just money that the bank owes you. And when you move commercial bank deposits from one bank to another, all you're doing is transferring liability. Wells Fargo, you deposit your paycheck into Wells Fargo. Well, really, they owe you that money, and then you want to move it to pay for your gutters, like I just did on my house last week. Well, now the gutter contractor, he's owed that money by Wells Fargo. It's a completely different paradigm with stablecoins. It's analogous to someone paying in cash. It's a digital bearer instrument. It's not a liability like a bank deposit. And just as importantly, as I kind of alluded to earlier, they're 100% reserved. So this sort of inherent fragility that you have in the fractional reserve banking system, which we saw with Silicon Valley Bank and a lot of the other regional banks in 2023, a tale as old as time. Anytime enough people show up and ask for you to move their liability from one place to another, the bank is going to fail. Stablecoins are completely different. They're 100% reserved. They're backed all the way down to the last penny with U.S. Treasury securities and dollars. And so they don't fail when people show up. So I think that's something that is actually one of the reasons you've seen banks push back, and we'll talk about that further on in the episode, so much against stablecoins or try to exert so much influence over the regulatory discourse, is because they challenge the two-tier banking system model that we've had in this country for the last 120 years, which is banks are the core creator of money in the modern economy, and they're who the government gives a license to.
Yeah, let's just jump straight into that. So as we mentioned in the first episode or other episodes, we're going to cover like multiple themes relevant to the deep dive. And so one of the themes we're covering today is regulatory clarity continuing to progress, but also there is some big pushback from the bank lobby. There's some more clarity on that just over the past few days. And there's a lot going on right now in kind of the regulatory debate. And the White House just issued some guidance on the Coinbase versus big bank debate, but let's dig into that a little bit. Dave, maybe kick us off with like a little bit of the history that got us here, where we stand on it now, and then let's just keep.
Yeah, so that kind of back to the history of stablecoins. One of the biggest things that's taken us from a crypto application for crypto users into mainstream adoption is until very recently, there was no coherent legislation or regulation that recognized stablecoins as a valid form of money and sort of put down the rules for who could issue them, how they could be issued, what kind of things could be held in reserve to back those stablecoins, what the rights of consumers were, who were holding stablecoins, especially in the event of a failure of one of those issuers. And we got that clarity with the passage of the Genius Act, which is federal legislation that was bipartisan. Surprisingly, in today's day and age, it's one of the few bills that this Congress has actually had the ability to pass. And it lays a comprehensive regulatory framework for stablecoins. It makes them, in my opinion, a very safe, I would argue safer than commercial bank deposits, form of digital money that now has direct oversight from the Federal Reserve and the OCC, a clear licensing path through state and federal paths for organizations that want to issue stablecoins. It mandates that every dollar that's used to mint a stablecoin is then used to back that stablecoin with short-dated U.S. Treasury securities. It really created the foundation of everything we see today, which was to make stablecoins very safe and legitimate in the eyes of large institutions, which wasn't the case before. Before, they were regulated in a patchwork state-by-state money transmission regime, where you had to sort of get licensed as a money transmitter in every state that you had customers. And there's a well-known list of shortcomings with that model. And this was the first time in history that the United States had sort of put forth such a transformative regulatory framework for such a new sort of financial innovation. And that's kicked off a whole other realm of debate over can you pay yield on stable coins? What happens, in the sort of case where one of the issuers goes bankrupt? Do they have FDI? Are they the people that hold stable coins? Do they get FDIC insurance? Do issuers get FDIC insurance? So the story is not yet written, but it was a huge step in the right direction.
Yeah, I mean, I think what's notable here is how quickly U.S. policy shifted on stablecoins and on digital finance in general. And I think it's a testament to the flexibility and agility and ultimate do the right thingness of the American system. We went from a place where digital finance, or crypto, or Web3, however you frame it, was pushed outside the US to entrepôts like Dubai or Singapore and other places, and how all that's kind of come home now to the US, specifically to New York, because it is the financial capital of the world. And this technological innovation being adopted now by US government and US regulators means that those institutions which make up the financial capital of the world, those large banks and asset managers that are based in New York, are seeing them as an important, viable, integral part of their business models, their tech stacks, and where the world's going. There's a tension that remains, as you might imagine, from these incumbents and this new technology. And that tension is focused on whether or not these stablecoin issuers could provide yield to stablecoin holders. The banks argued that this was tantamount to causing deposit flight, would be tantamount to causing a deposit flight, and as such would reduce their available reserves, which would imply a reduction in the amount of credit they could provide to their communities. And one of the easiest places where the banking lobby can pull on those heartstrings is via the community banking space, and specifically whether or not community banks will continue to provide credit to the local communities they serve, many of which are underserved as the big banks have pulled out and really focused on their wealthiest clients and their largest corporate clients. And I think there's a real problem with that banking lobby argument. The biggest problem for the banking lobby is that the White House doesn't buy it. That's their biggest problem with that. And I'll read to you something that came, which Samantha was kind enough to share, which came last week from the White House's, the President's Council of Economic Advisors. And it says, regarding yield being paid on stablecoins, at baseline calibration of CEA's model, eliminating stablecoin yield, the current state of affairs, which is stablecoins don't pay yield, would increase bank lending by 2.1 billion and has a net welfare cost of 800 million. That translates to an increase in lending of 0.02% and a cost-benefit ratio of 6.6. Large banks would conduct 76% of this additional lending, while community banks, which have assets below 10 billion, would lend the remaining 24%. In our baseline, that adds up to 500 million in additional lending from community banks, meaning their lending rising by 0.026%. So let's just put this in context. Because of this restraint being applied to this growing stablecoin industry, because of this heavy restraint, community bank lending is up 2 basis points. For the cost there's a cost on the other side of that 2 basis point gain, 2.5 basis point gain. And that cost is the hampering of innovation. This is clearly an innovative part of the economy. It's clearly an innovative part of the economy that doesn't have incumbents in it, which means there's more likely to be young people in it, young people experimenting, young people creating jobs for other young people, et cetera, et cetera. It's a very global business. It forwards U.S. interest by reinforcing the dollar as the dominant currency in the world. And for the cost of restraining that innovation, for the cost of restraining U.S. dollar supremacy through this technology, for the cost of the job creation that goes with that, the White House believes the gain is 2 basis points in bank lending. Frankly, if banks turn down the thermostat a degree or two, if they maybe, chose any number of productivity optimizing things, the available reserves from retained earnings would give them far more capacity than the 2.5 basis points that the White House believes they've gained in credit growth from restraining the yield on stablecoins.
Well, and to give our listeners the full, I'm going to give them the other side of the argument. So that is what the White House has said. What the banks have said, when the Genius Act, from the moment it was a draft bill being reviewed by Congress, they put in a prohibition that said issuers of payment stablecoins, which is the formal term that they use to define a stablecoin in the legislation, are prohibited from paying interest to stablecoin holders. And the reason why that was so important for the banking lobby is their line of reasoning is that if I can hold a fully reserved dollar that's not susceptible to runs because it's fully reserved, unlike money in JP Morgan, that can be transferred for free 24/7 by 365 in real time and pays me 3 or 4%, that there's no human alive that's going to opt for putting their money in a commercial bank that's at risk of a run that pays them 10 basis points and settles in 3 to 5 business days. So they basically said, this is such a good product, if you put this out there, everyone's going to pull their money out of our banks, which could cause us to fail in a worst case scenario, but at a minimum is going to mean that we can't issue the levels of credit that society needs us to, because we depend on deposits to give us the ability to, I take in $10 of deposits, I can write $100 worth of mortgages, the simplest way to explain that. And so if those $10 deposits leave me, that's $100 of mortgages I'm not writing, or small business loans I'm not writing. And so the letter they wrote, they said it could lead up to $3 trillion in deposit flight. So the White House is saying, and so $3 trillion of less deposits, that's 30 trillion or 300 trillion. That's orders of, multiples more credit that can't be created, right? Because we use fractional reserve, you get in $1, you lend out 10. And so how can the White House and the banks be on, the White House is saying, 500 million, that's nothing, that's a freaking rounding error, right? The banks are saying 3 trillion. So which is it? I think it's a really interesting.
The biggest problem that the banks had was that the White House didn't buy the story, as I just demonstrated. Yeah. The arguments that the banks were making, which I think you did a good job of summarizing, has some other problems. The first of which is the banks should have a business model that doesn't rely on their depositors not being wise enough to take their 10 basis point yielding deposits and put them in T-bills yielding 400 basis points. So the first problem that the banks have is if they're going to rely on their incumbency and their regulatory capture to provide services, then in this generation of technological acceleration, they will have big problems anyway. So first and foremost, they have a problem of a model which doesn't pass through the federal funds rate appropriately to their depositors, consistent with the objectives that the Federal Reserve has for setting monetary policy. And they sit on regulatory capture, being the only ones that can pay this deposit yield for the moment, as an enabler of that lack of innovation. So their first problem, other than the White House doesn't buy it, is their reliance on regulatory capture in lieu of providing the monetary policy transmission that the Federal Reserve would like, and the rates of return and services that their customers should expect. And because they're relying on regulatory capture instead of doing their job of transmitting monetary policy and supporting their depositors, they are going to be vulnerable to innovation, technological or otherwise. So that's the second problem they have. The third problem with that argument is that assumes nobody else in the economy wants to provide credit. let's take your hypothetical that that on a 10x leverage ratio, the 3 trillion of deposit flight reduces credit provision by 30 trillion. I mean, that's the size of this economy. That's kind of silly, but let's just go with it for a minute. That would imply that you and me and Samantha don't want to lend money in an environment when obviously interest rates would be pressured higher because there'd be a paucity of credit. I mean, credit creation itself doesn't solely rely, and frankly shouldn't rely, on the bank's regulatory capture. It should be a function of the productive use of that capital. It should be a function of, in a capitalist society, investors' demand for a return that compensates them for the risk that they take. If we got into a world where stablecoins paid yields, let's continue this logic, where pays yields, and the deposits flee the banks to the stablecoins, well, one of two things will happen. Stablecoins will then turn themselves into banks with better technologies. They provide credit to those borrowers. Or people would say, I don't want the yield that comes from the stablecoin. Other innovative financial market participants will enter the fray, those same banks, and they will find a way to be an intermediary between savings in the economy and credit creation. There's no world in which deposits all went from banks to stablecoins, and all of a sudden, nobody in America wanted to make money lending money again, which is what that argument would imply. All of a sudden, all of the yield, and by the way, let's do the logic of that, just to put on our monetary hats. What would happen then? What would the Fed do if there was no provision of credit into the economy? The economy would crater on itself, right? Fed rates would go where? They'd go to zero, if not negative. The stablecoin providers would no longer be providing any yield on the stablecoin because there'd be no yield on the T-bills. And now everybody would be back to scratch, asking them, how can I provide financial services that intermediate savings and demand? So even if that logic was right, Fed funds would go to zero anyway. Nobody'd be getting yield on anything. And everybody be back to square one, which is, how do I entice investors and depositors to provide their savings so that borrowers can generate a demand, a healthy demand, a risk-adjusted demand for credit?
I think you hit on some really important points there. And I think that the most important thing that you hit on is that the reason stablecoins are such a big deal, actually, technology is a second order effect of that. It's nice. They move fast. They're programmable, blah, blah, blah. But just like Bitcoin, the reason it was so disruptive and it made so much noise and continues to make so much noise, it's pushing a fundamental rethink of market structures and the roles in which participants play in those structures and the way that governments give certain entities in that market structure superpowers that they use to do things like create money. Like banks have a superpower that, like, to your question about like, well, you know, if the banks aren't lending, won't Sam and Ian lend? You don't have the superpower that banks do. Banks can take $1 and lend 10. We can take in $1 and lend 1, right? So, you know, they have that and stable coins are really kind of like unearthing. And this argument, this reform of market structure, is actually predates stablecoins by a long time. Mervyn King wrote a book about it, The Alchemy of Finance. He was the exchequer of the Bank of England during the GFC. And his epiphany, having lived through the hell of GFC, was actually that we should do what stablecoins are doing now, which is we should reform the basic market structure of the two-tier banking system, and we should have narrow banks, which exist to provide payment utilities as a societal good, where they're not fractionally reserved. They're not credit creators. They exist to serve as the plumbing for society. There's actually really interesting, like, what happened in the GFC when some of those banks started to fail. Like, people's ventilators started to get shut off because RBS, was like paying people's hospital bills. And all of a sudden, when they were going through issues with their payment systems and their solvency, people's like hospital bills weren't getting paid. And so he's like, you know what? There needs to be certain institutions, which today have surfaced as technology-enabled narrow banks, which is a stablecoin, that should only do this and do this one thing well. And then there should be commercial banks which take a riskier approach, and they do maturity transformation, and they're fractionally reserved, and they're the primary creators of credit, and they have this superpower that we give them in exchange for them following the rules that we lay, which is I can take in $1 and I can lend out 10. That is a deep debate that's been happening in banking for a long time, and stablecoins have just kind of like re-earthed it and put gasoline on the fire because they are much better from a technology perspective.
Yeah, I want to comment on something you said, which is the example I gave was obviously a very strong example of a 0-1 scenario. Number one, that would happen slowly in that world. But more importantly, banks aren't the only source of leverage in the capital markets. We could imagine if you look at the insurance markets, they're clearly based on leverage. If you look at the way the BDCs act in private credit, there's clearly leverage there. If you looked at the mortgage on your house, there's leverage there. You put up 10% and the banks write that mortgage credit, but agency mortgages are then backstopped and insured by the GSEs and Fannie and Freddie, which even without the government guarantee can be a very profitable business. There's lots of ways we can get leverage finance in the system. And in a world that was so radical that all the banks shuttered and all the deposits wound up in stablecoins, I have enough faith in the U.S. economy that we would see plenty of industries that were creating credit and creating credit in different terms with different mechanisms, et cetera. So whilst banks have a very unique licensure and access to the Federal Reserve for liquidity, which is hugely important, and a nice government relationship when it comes to FDIC insurance, and certain tax incentives to how they work. At the end of the day, the radical world of 3 trillion departing the banking system and resulting in a contraction of 30 trillion in credit is a world that implies that nothing happened in the interim. Not new industries, not provisions from the now holders of savings, no response function from the Federal Reserve, just nothing. Just we were in a totally static system and it just went there and then nothing else happened. And so, I do think we're going to go to a world here where financial services, like other industries, will become more competitive because of technological acceleration. Banking is a key part of financial services. We'll need to think about the role that it plays in doing that. I do think the banking system has another superpower, maybe one that's on a more honest footing, but genuinely earned, which is their last mile relationship with the borrower. And I think there's real value in that. And I think to underestimate their ability to underwrite credit because of that last mile relationship would be unfair to the banks themselves, many of whom across the country do a phenomenal job of allocating credit because they have the processes in place and the technology in place to underwrite that credit on Main Street. And just because we saw an extra $100 billion go into stablecoin providers doesn't mean that they have that last mile borrower relationship. And the efficiency and intelligence and processes associated with managing that last mile relationship mean that they can provide credit at a cheaper cost, at a more competitive cost than others would be able to at scale. So they've scaled the last mile relationship. They've scaled the processes and technologies and marketing and that which goes along with it. And that scale and that intelligence and that value add is a moat, which means that they can provide credit at a cheaper price. Now, when you find yourself as a borrower with a particular borrowing need that's less cookie cutter and you can't get it from a bank, well, then you see other private credit lenders out there in the market that provide that credit. But and by the way, that share of the market has grown as banks have retrenched and become more concentrated. But it remains the case for the middle of the down the fairway stuff, that last mile is very valuable. And to the point we were just having, where banks have pulled in from that last mile lending, we've seen plenty of other institutions fill in the breach to provide that capital, to provide that credit with a different funding source than deposits. And I just think
what you just said is 100% true. And also you said something earlier that kind of wraps right into the point you just made, which is what if, so the reason why this is an issue, if $3 trillion leave the banks and go into stable coins, in the words of the banks, is because deposit flight is bad, because these community banks can no longer create credit. That is because the bill has told the stablecoin issuers that they can't create credit and that they actually have to limit their exposure to the banking system because they've acknowledged how fragile it is. Circle had a DPEG event, and it was big news where on the secondary markets, one USDC was no longer worth $1 because everyone was worried because Circle had $3 billion of its reserves in Silicon Valley Bank, which did fail, right? And so they've told Ingenious, they've said to these issuers, you can't do any credit creation other than lending to Uncle Sam, and you need to limit the amount of money in our reserves that you keep in the banking system at any given one point in time. The problem you described goes away if you take those reins off of those stablecoin issuers and you say, you know what, the issuers are really just a new way to collect deposits. And hey, guess what? We can now collect deposits from the entire world because anyone with an internet connection can mint USDC. And then those issuers can use it to create credit or deposit those back into their banking partners who now, you know, the deposit base has gone from, you know, X million individuals to one issuer who's collected those deposits from those million individuals. You see what I mean? So it's almost like one could say that like really what they're complaining about is that it's just challenging the fact that they can no longer pay 10 basis points on their checking.
Well, Dave, it's like you talk about all the time, right? It's, hey, the taxi lobby pushed back on Uber just because it was a better product. They knew it was a better product. Now the bank lobby is pushing back on stablecoin issuers paying yield because they know it's a better product. And so, yeah, there is more to it than that. Then, you know, the banking industry needs to survive in the U.S. for credit creation, but it's not doing the consumers any favor. And to Ian's point, go ahead, Ian.
Sorry, Samantha. Just a little thing, which is, you know, it's worth looking at what the profitability of the banks are and asking yourself, does a 50 or 55 or 60% cost to income ratio consistent with the technological innovation that we see? Maybe the cost to income ratio for banks should be 25%. That's basically your overhead costs of generating the revenue that you generate, right? Like it's unclear that what has been for quite some time a 40 to 60% cost to income ratio is consistent with the adoption of technology that we see and the digitization of money broadly and the digitization of financial services. And it would be a good idea for banks to look at this accelerating technological landscape, see how they can incorporate these technologies into their own business models. There was a great interview that we shared amongst the three of us on Western Union and what they're doing in stablecoins. Maybe you want to talk about that a little bit, Samantha. But it's usually the case that at times of technological creative disruption like this, the winners are the ones that evolve and pivot and change and grow, become more productive, become more efficient. And the losers are the ones that seek more regulatory capture and more protection from the government. It's not even a political argument. It's just a historical fact that Group A typically fares a lot better than Group B in the medium term.
Well, I think it comes to go ahead, Dave.
Well, we've seen, that's an important point for our audience, is actually the discourse now is that we have stablecoins, which are digital dollars issued by payment stablecoin issuers, which are fully reserved. And then we have tokenized deposits, which in terms of their form factor are a blockchain token, and they work exactly like USDC or USDT. But the primary difference is they're issued by someone who has a superpower that the government's given it, which is you are a bank, so we are going to allow you to issue a tokenized deposit, which is different from a stablecoin in basically two key regards, which is you don't have to back it 100%, and you can back it with illiquid mortgages and small business loans, and you can basically run the business model of a bank, and instead of your checking account running on a 1970s database, the balance in your checking account is now represented as units in a public ledger called a blockchain, right? And so the banking lobby has sort of responded and said, you know what, like we're going to do this stablecoin thing, but we have a superpower and we're going to beat them because the government says we can do a lot more with the reserves that back it. And so that's a really when we talk about stablecoins, there's actually two very different models that have emerged. The stablecoins, as we've described them, is by far the dominant issue or the dominant player in the world. But banks like Brian Moynihan from Bank of America has been out very public about this. Jamie Dimon, a lot of different financial leaders have talked about creating tokenized bank deposits, which look like stablecoins. The real interesting thing there that I think is really the biggest question by far for tokenized deposits is, will they work like stablecoins do in terms of permissionlessness? So can the banks actually stomach, and I would say they can because they already do it today with cash, but can the banks stomach and the regulators stomach that banks are issuing a liability that can be freely tradable all over the world to anyone with an internet connection, even if they haven't gone through KYC, right? Which is the case with stablecoins today. And that's one of the reasons why stablecoins have gotten such great level of adoption in emerging markets, is because they're just simply a new way for these people to hold and access and save and earn in dollars. They don't care about the blockchain. They just want to get out of the peso, right? They want to get out of real. They watch their savings get printed away every decade, right? As another, Latin American government goes through a debt crisis and, prints its way out of it. And so that's why they're using stable coins, right?
Well, and Dave, when you say great adoption, just so everyone knows, like the estimates are that 1 in 4 people in Latin America have interacted and used stable coins.
Yeah. It's astounding. A lot of these companies we work with are customers of Open Trade. And, these people, they're remote workers, they're savers, they're retirees. They want to travel, they want to save for college, they want to save for retirement, they want to save for, life expenses. They want to transact in a cross-border, hyper-connected economy. They need dollars to do that. And the easiest and fastest and cheapest way to hold dollars now for them is stable coins. That has nothing to do with crypto whatsoever.
Yeah, I think this is a good point, as we keep hitting on it, but another key theme of this episode, and just a key theme that we're all experiencing right now, is that you have this technological advancement of what stablecoins and what stablecoins can do. And so then all the institutions, banking institutions, Wall Street institutions, financial institutions, are trying to figure out, okay, how do we keep up with that innovation? And so part of that is some of the M&A activity that we've talked about before. MasterCard just bought BB&K for $1.8 billion. Stripe bought Bridge about 18 months ago for $1 billion. They were a $10 million revenue company. So we're starting to see everyone saying, okay, we have to figure out how we're going to innovate, and we have to figure out how we're going to adopt. Back to your point, Ian, the world isn't static. And so the behemoths are trying to move, and you're seeing that all the time. You have the bank deposit coins, which Dave already hit on, but you have all these other blockchain groups now trying to figure out, okay, how do we stay on top of tokenization, and how do we stay on top of stable coins? So I just loved, all I was going to do was bring up the, I loved the video that you passed around in the group chat, Ian, that had to do with the Western Union CEO and his conversation at Digital Asset Summit a few weeks ago. So they're issuing their own stablecoin. Some people are choosing to issue their own stablecoin. Some people are choosing not to issue their own stablecoin. Worth talking about that dynamic. But first, walk us through, why is Western Union issuing their own stablecoin?
So Western Union is an example of having that last mile value add that we spoke about before. Millions of customers, thousands of branches, maybe millions of branches when you think about all the places where you find a Western Union. That last mile network's really valuable. It's a trusted brand. It's regulated in many different countries in many different ways. It's got real scale. And the way that they were managing their business before is to create that instantaneous settlement for their customers. They were needing to put money into the banking system, and their money would get tied up with, just like everybody else's, maybe slightly more preferential terms, but money centers do what money centers do, and they would be tied up, and the float on their money, the interest on the float of their money would be earned by somebody else. So they'd have to take their cash, pledge it into the banking system to facilitate relatively instantaneous settlement for Western Union customers. Now, through the use of their own stablecoin, that happens just as instantaneously, but without them needing to tie up their cash in the banking system. And that means that the return on their capital, the return on their float, goes right to their bottom line. Western Union's a phenomenal example of using this technology to grow your profitability by adopting it and continuing to leverage and even doubling down on your core value proposition, which is their last mile relationship. And last mile relationships are hugely important. I mean, you can speak to this as a venture capitalist better than I can. If you guarantee me last mile relationship real estate, you should figure out a way to make some money. That's the hardest thing to figure out. It's another way of saying the product market fit. It is the attachment point, and it is hard as heck to build a network effect at scale that has that. And these institutions that we're talking about today have that, and that is the most expensive thing to build. It takes long, it's both in time and money, is that last mile value add, and the systems to support it, and the brand that lets it endure. So I think that was really interesting about Western Union. I want to come back to something else that we said, if that's okay. So, I want to just stay with this chronology of the adoption curve for stablecoins. I think this is the right episode to have that conversation. So they've started off. So Turkey, we had crypto companies couldn't get bank accounts, wanted to transact with people in crypto, Bitcoin predominantly. Okay. Then we saw the growth of this and access through the internet connection that allowed people to save in dollars. Then we saw stablecoins increasingly being used as a way now for corporates to participate in this acceleration of technology while leveraging their last mile. And I think now we'll see two places that are really valuable. One, Samantha, you touched on, which is how do people start using stablecoins in their own business models for global scale? Maybe let's call it a parochial stablecoin, where the revenue model is on the redemption, is on the seniorage, but the stablecoin is used for very specific use case. And I think we'll start to see, and we're deeply involved in a project that hits on this theme. And I think that's a really important step in this adoption curve. We can think of some theoretical examples, but if there was a market you really wanted to use for prediction or for sneakers or for something else, and the only way you could use it is through using the native stablecoin, well, you would use the native stablecoin, et cetera. The other place where I think you'll see this adoption curve grow is in non-dollar stablecoins. The technology here, now, the reason why the dollar stablecoins have grown is the dollar's accepted almost everywhere in the world as a means of payment, and thus retains quite a bit of value despite inflation as a reserve for individuals and governments and businesses. But there is a reason to use stablecoins that is not for that in other countries. And I think, there are big countries, lots of people in them, and instantaneous settlement and surety of execution and just as valuable there. You've seen a new initiative from the Swiss National Bank getting together major institutions in Switzerland to really push on this theme. Swiss franc is a relatively international currency, certainly relative to the size of that economy. I am surprised. If you ask me something I'd be really surprised about in the stablecoin space, it's the lack of growth of euro-denominated stablecoins. There are a few that are out there, but that's something that's really surprised me. So, maybe I'll be wrong on this, but I think in general, things are going digital. And there are other big markets in the world that should see growth of their native stablecoins.
So people actually ask me all the time, it's like, why aren't there more non-dollar denominated stablecoins? And I have a slightly different take than you, which is, I don't know if it's different, we'll see, is stablecoins shine in cross-border use cases because that is where payments today are the hardest. Um, there's a lot of emerging economies that have gone through their, skip the landlines moment and put in place digital payments infrastructure that is amazingly good compared to what we're used to in the United States, whether it's Pix in Brazil or M-Pesa in Kenya, where India has a great digital payment system. The UK with faster payments. I've lived in the UK for 8 years. I can't imagine actually needing a stablecoin in my daily life and just transacting within the four walls of the United Kingdom because pounds move instantly and for free in the UK. It's the cross-border use case where they really shine today. I'm not saying that's always going to be the case, but it's certainly the lowest hanging fruit, certainly has the most friction, it's the most cost. And there is really a role to play for blockchains there, which is you need this credibly neutral infrastructure so you don't have essentially a holdup issue where one country or one organization runs a database where all of the world's transactions settle, which is a whole other story.
So let's mix it up on this point.
Cross-border, okay. My last point is, it's still king dollar when it comes to cross-border. That's why. No one wants to people aren't settling global trade in reals, right? Or in pesos. It is dollar and maybe some euro and yeah, obviously yuan and the ruble in sort of the pariah states, but it's still king dollar, and I don't see that changing anytime soon.
I don't know that king dollar changes, but I do think there's one thing which we failed to mention about stablecoins on this call, and it's probably the best counterpoint that I have to an expectation that we won't see a notable rise in non-dollar stablecoins, and that's the growth of AI agents and agentic finance. And whether you need stables for cross-border payments or not, each of these countries is going to have agentic finance. And it's going to be very hard for AI agents, which are going to be a huge percentage, probably the majority of labor at some point in many countries over the next 50 years, to not do that in stablecoins. You need that bearer instrument. You need that lightweight bearer instrument. AI and AI bots are going to take advantage of that lightweight instrument, and they're going to do so on platforms that are agentically built, which there are very few of today. I give shout out to some really great entrepreneurs I know in the agentic finance space right now, but for the most part, I don't know that anybody here can name an agentic finance company off the tips of your tongues. It's all pretty new, and it will need stablecoins. The other point that I would make is, which is, I guess, part of this point, a sub point, is we really haven't seen the growth yet of stablecoins as the revenue model for platforms, for e-commerce, for digital services. And I think that it's a really interesting lightweight way to keep money inside your platform economy type of a company. So if you're in a company that's doing a lot of different things, let's take Alphabet, for instance, right? Think about all the things you could do, all the Google things, from Waymo to AdWorks to everything else that Google has, right? Just imagine if you used Google Bucks and what it would mean for Google to just have force everybody into Google. Clearly they don't need the dough, but you do have a whole economy of multiple vertical businesses that transact with each other, right? You have with lots of different consumers and lots of different places and lots of different platforms. So there is probably Apple's an example. They took a shot. Meta's an example of wanting a stable coin. So you don't have the rise yet of these platform ecosystem businesses as stablecoin issuers themselves, but you could see that taking place and the float therein being a hugely profitable tailwind. And that also isn't as much, there's some cross-border aspects. Obviously, these are big global companies, but there's some aspect of just keeping the float inside of your own ecosystem platform type economy business. And I think, especially as those businesses become more agentically driven, that will make more and more sense for those companies to have native stablecoins as a revenue driver, because the agents that engage with those platforms are going to want them anyway, and keeping an internal float is going to be pretty obvious.
I agree with that, definitely. And the agentic piece, for sure, is like, it's for anyone listening, in an agentic machine-to-machine commercial world, you need stablecoins. Like, they're the only medium of exchange.
And also give Dave and I a call if we want to talk.
Well, I was just driving. I'm in San Francisco.
First, give me a call, get some money,
Yeah.
and then give David a call.
I'm in San Francisco right now, coming down the highway into the city from the airport, and on big ass billboard is Stripe advertisement for their agentic commerce. Well, what's Stripe doing? Investing heavily in stablecoins. Why is that? What you just said is what they see, right? And so they're going to basically create their own bank. They've already applied. They're going to issue their own stablecoin, and that stablecoin is going to be the medium of exchange, the unit of account, and the store of value for Stripe's universe, especially as applied to agentic commerce. And that's how I think most people will start to adopt stablecoin, is these big financial incumbents are the ones that are going to move to stablecoins, and then you just start using them without knowing them. On the meta piece, that actually is a really interesting thing that you raised. It's an important part of stablecoin history that we didn't touch on, which is that Meta did try to launch its own stablecoin. I think it was 2022, maybe 2021, and it caused an absolute, I think I can cuss on this podcast. It caused a shitstorm, for lack of a better term. Literally, like, people were hauled in front of Congress, and it was shut down with all the might and weight of the government, literally, because it was going to be a consortium. It was Meta as the lead, but they had a lot of other companies that were going to be involved in issuing and supporting it. And some of them were financial institutions. They got called to Washington, and they said, if you do this, your name is mud. You're done. You're done. I promise you. Like, literally backroom stuff. And there's a lot of people that were part of that project that wrote about it later on. One of them, actually, who's Dante Disparte, who's Chief Strategy Officer for Circle, now at USDC, talks a lot about his experience in that. And that's because, going back to our example of how disruptive these things can be and how much the incumbents really did fear them, was, imagine, there's 1 billion Meta users on the planet. Imagine if they roll out their own stablecoin. And now anyone with Messenger or Instagram or Facebook, they become their own bank. That is where you really could see some deposit flight. That's serious. And so, like, I'll be interested to watch what they do. They tried it before. They shut it down because the government said, we're going to take you to the cleaners if you move forward with this. And now that the government's pro stablecoin, we haven't really seen anything new with Meta, but that's a really important part of stablecoin history. And it highlights the shift that we've gone through, where doing that 5 years ago under the prior administration was, no go in every sense of the word. And now it's open season.
Yep. And it won't be, it'll be in smaller places and bigger places. You can imagine situations where insurance companies with their float want to see that in stables and the yield that comes there. You can imagine a place where the government gets, in a positive way, more becomes functions a larger part of the digital finance economy, and they want to see stables because their agentic engagement works better there, and they're in the OECD 30 to 60% of GDP, and so they're a huge participant that comes in. So I think there's still quite a bit of adoption curve to go here, but I do think that you'll see business models that step up for the parochial stablecoin trade, and I think that'll be exciting. To date, it's been about the cross-border piece and the savings in the dominant currency, but that'll evolve now. And I think that's probably a this year event. I think by the end of the year, there'll be things we'll point to in this podcast that speak directly to headlines around this.
Yeah, it already is moving so fast. Like when I met Dave 14, 15 months ago, Dave, we were talking about how stable coins that were focused on payments had really taken over the market. And then the next wave is going to be yield. And now there's yield. Everything is talking about yield. There's entire yield ecosystems that are just around how to get yield off of your digital assets and stablecoins specifically. And then what's next? So that actually leads us to our perfect closing segment, which is just called The Signal. We want you guys to think about one thing that you can say in a few sentences that you're really watching or really paying attention to as in the stablecoin realm as the innovation continues to progress. I'm happy to start, unless you guys want to jump in.
Please, no, start.
The one that I'm watching is what we hit on, but we didn't do a super deep dive on, all the different institutional adoption that we have now. So we talked a lot about the innovation that's happening and the pushback we're getting from incumbents, but because of that last mile delivery moat that the incumbents already have, Ian, I think it's going to be really interesting to watch and see who's really going to win when it comes to a lot of the innovation that comes to market here. Is it the incumbents who are acquiring startups or doing their own blockchain groups and issuing their own tokenization platforms and their own?
Well, let me tell you,
coins?
those guys with those startups getting acquired, they're winning. They're not winning. They're not winning.
No, you're not winning, but as we all know, getting acquired by a big incumbent also can, in some instances, stifle some of the innovation that you also would have been bringing to market in the future. And so I'm really curious to see how the incumbent versus challenger shakes out. And I don't think we're going to have a clear answer on that for a while, but it's going to be a good one to watch.
So I think I want to see what happens with this Swiss consortium around their stablecoin. I think that'll be really interesting to see how that consortium engages then with private stablecoin issuers globally. What does it mean for the Swiss banking system and Swiss corporates to engage in the stablecoin economy with USDC and other stablecoins? Obviously, non-dollar stablecoin transaction and is a big deal. And I think watching that proliferate could affect FX markets fairly substantively, and is worth keeping an eye on. The other place where it's near and dear our hearts is the way in which stablecoins are used for instantaneous settlement. And there's a couple big players in the credit space that have started to use stablecoins. Figure Technology is a good example. Obviously, Profit is trying to do that in the credit space as well. I think we'll see a proliferation of instantaneous settlement in high finance, and that will open up the next massive wave. And I think that's a this year event.
I'm watching all of those things. I'll give you one thing I'm not watching, and one thing I am. Token prices, I'm not watching. So I think that we'll talk a lot about crypto and token prices and how they do interplay with sort of the convergence of tokenization and stablecoins into mainstream finance, but by and large, they've decoupled themselves. So, stablecoins over the last 5 years have shown backed by evidence and data that their usage and their adoption rates and their market capitalization has been decoupled from crypto prices. That wasn't the case, in 2015 to 2020, really. They were firmly coupled because their only use case was trading crypto. Not the case anymore. And so what Bitcoin does, what Ethereum does, I really don't think it sways. I mean, it has an impact, but it's not like if Bitcoin goes to 200,000, stablecoins go to 2 trillion, or vice versa. If Bitcoin goes to 10,000, stablecoins disappear. They firmly decoupled, so I don't really watch those prices.
Yeah, I agree. I think we're having a digital finance conversation, a Web3 conversation, blockchain conversation, but what we're not having is a cryptocurrency conversation when we talk about stablecoins.
The thing I am watching and I constantly keep an eye on is just the dollar. So all of the geopolitical, macroeconomic forces that impact the dollar, whether it's oil markets and war in Iran, sanctions, tariffs, the rise of China and their sort of the strong efforts they've put forth with their own stablecoin and using that as a way to sort of subvert the dollar and get the yuan to be the new sort of currency of last resort. But what the dollar does really does have an impact on the stablecoin markets today, way more so than crypto prices. And so where the dollar goes and what the dollar does really does have a bearing on stablecoins and vice versa. I think stablecoins will actually, and we'll talk about this in the next episode, I think, is drive a huge amount of demand for dollars and be a key tool in sort of sustaining dollar hegemony in global trade.
Yeah, there's a big reason why Washington cares and why the Trump administration is so crypto friendly and especially stablecoin friendly. So coming up soon, next episode.
Yeah.
Thank
All
you.
right. Good job, guys.
See you guys. Thank you.